Morning, good evening, wherever you are. This is going to be a slightly different video to the ones that I normally do. This is going to be more of a presentation style video, so if you enjoy this, just let me know. And let's start. So, as you can see, this is the types of trading, and this is primarily for beginners. Now, you can watch this if you're intermediate or advanced, just as a touch up. So, to start with, we've got scalping or day trading, right? Now, essentially, scalping or day trading is, I would say they're interchangeable. Scalping is more of a shorter term version of day trading, but you essentially buy and sell on the same day, and it's not held overnight. Now, the reason why this is quite a distinguishable factor is because when you hold something overnight, you get more fees added on top, and you have spreads, which increases the likelihood of you essentially making a loss. Now, it's also much harder to start with because there's more issues in day trading in itself, even though there's a higher likelihood of you potentially making profit. Um, there's also increased frequency of trades due to the nature of it. So you'd be obviously taking more than one trade a day, or sometimes even none, depending on your strategy. Um, there will be leverage positions. So what I mean by that is whenever you have your account, it'll be with a broker, and most likely, more times than not, it'll be leverage position. Now it could range from 1 to 30 to all the way up to 1 to 500 leverage. That all depends on your broker and the contract that you have with your broker. Now, the pros of scalping or day trading is patience is not needed as you're in and out during the day, so you can manage your trades throughout the whole day. If you have psychological issues as well, this helps. There is higher profits. The reason being is because over time it compounds over time. So even if you're getting small amounts, it just compounds over time versus one large move where you hold it throughout. The next point is continuous improvement. Now, what I mean by continuous improvement is because day trading, you're doing this day in, day out, you sort of understand the markets a bit more. You understand what it takes to be a trader. You understand the nuances that occur because of the frequency of the trades that you take is way more compared to other trading styles. So that means you'll be improving way at a quicker rate in day trading compared to other trading systems. Now, the cons of day trading, put it simply, it's very high risk. Now, the reason why it's high risk is obviously you'll be trading your own capital, or if you have a prop firm prop capital, at a higher leverage position than normal people, I guess. That increases the likelihood of you losing as well. So, as quick as you can make money, as quick as you can lose money, right? Now, it's also very, very stressful and involves a lot of psychological management. The reason why I say that is because, as you see in the charts, you need to understand that you may not get a trade that day, but you still have to be patient and see what's going on. One, two, there's a lot of more psychological management and stressful as you're managing fast moving positions quickly. So you have to think about it a lot, and it have to be very quick decisions. Now, it is also time consuming, uh, ironically, considering that this is the shortest trading style. The reason why it's time consuming is because you'd have to sit in front of your charts and wait for your setup or your opportunity to occur, and that may not even occur. So it links time consuming and stressful and psych management together. So this is only, I would suggest you do scalping or day trading only if you are 100% sure that you want to be a trader, right? Because it's the hardest of the bunch, but it's the most profitable if you can make it. That's the thing. Now, there's also limited capital growth. The reason being is because you have a lot of fees and spread that could reduce how much you make. So, let's say, for example, you entered a position and you're looking to take out at 2 times whatever it is. Usually, what ends up happening because of spread and fees, you'll have to take out slightly above 2 times or your risk essentially. And there's also a risk of over trading because you're in and out during the day. You need to manage how many trades you take, when do you stop, when do you continue, etc., etc. That is something you need to know. So with this, I would only suggest this once you have a fully dedicated trading plan to do this, and you've had experience in the markets for a while. Now, the best instruments to trade this will be foreign exchange pairs, indices, and futures. The reason being is because it has enough volatility where it makes sure spread doesn't hinder you as much as other asset classes. like let's say stocks or commodities. So that's the sort of instruments that you'd want in those in day trading basically. Now on to the next one, swing trading. Now you can see you're literally holding positions for days or weeks. So imagine this is a day chart. You'd be holding for days or weeks, and it's usually focusing on medium term trends. So for example, like a short to medium term trend where it's about a few days or few weeks that it lasts. Um, so what you end up doing is you also be using seasonality and other market pairs for correlation. So what I mean by that is, let's say for example, I'm looking at FX pairs, and I see this is euro against the dollar. I'll look to see some similar move happening against the pound and the dollar. So that's how I know they'll be going the same way or they're related. Um, that's why it's easier to see. If you are a beginner and you do like trading frequently, I would say swing trading is the best way to start. Now, the pros for swing trading itself is that that is less time intensive. The reason being is because you'll only have to wait until, let's say for example, you wanted to buy, you'd only have to wait until somewhere around here to look to buy, right? So you're only paying attention maybe one day out of 6 7 days, it looks like. Now it's also more flexible because you have several areas that you can enter off of, and few hours, or yeah, few hours you can enter off of. So you do have time. It's not something where can you'd have to sit in front of the charts like day trading or scalping. Now there's also lower transactional costs. Now what I mean by that is there will be less fees occurred because you're just trading with one, you're trading less. Two, the moves that you do catch will be held on for a long period of time. So the only fees you're looking to pay would be overnight fees versus spread fees and commission. And lastly, for pros, it's less stressful compared to day trading because you have more patience, you have time to think, you have time to relax, you have time to battle your psychological demons in terms of overtrading. Now, the cons that occur with swing trading are holding overnight. So the reason why I say holding overnight is because if you hold anything overnight, the spread is increased. So unless your stop loss is at a good position, you may get tagged out and you may continue in your direction, which can be a headache in itself. Now, you also need patience. So why I say patience is a very, very key factor in swing trading is because even if you, let's say for example, in this sort of image, even if you enter here, right, you will need to have the patience of holding for any retracements, expecting your idea to play out or work, right? So that is something where it's a different psychological burden compared to day trading, but that can affect your sort of overall results. Because let's say for example here, and I just take it out here, that's me stopping this whole move, right? Me getting more money. Now I also need a larger, I would need larger capital purely because to make money you're going to need money, and if you're going to hold it for a long period, you would need large capital to hold it. This is not something you can do with a small account. I mean, you could, but it's not going to be ideal or feasible at all. Now, lastly is opportunity costs. Now, this occurs when you have low leverage positions. The reason being is, let's say, for example, you decided to enter on this, but there's another pair that pays that's uh, moving similar, but ends up moving a bit more. Uh, you've missed out on that purely because you've invested your capital in this specific trade, so you've locked it in this trade, so you wouldn't have capital for the other trade, and that can occur. So it's literally management of patience and making sure that your analysis is right. Now, the instruments I would recommend would be stocks, ETF, FX pairs, futures, cryptocurrencies, indices, commodities. They all pretty much work with this because this is a nice middle ground to trade on, swing trading on each of these pairs. Now, on to the next one, which is position trading. Now, position trading is a longer term position. This is suitable for people that really want to check maybe once a month, once every 2 weeks, if that, and you hold positions for months or years, and you look at long-term trends and fundamental analysis, right? The long-term trends could be based upon seasonality or interest rates, and you compare it to other, well, seasonality because usually the same things occur seasonally, throughout the years in the markets. Just the way it goes, like the ups and downs. Just yeah, and then if you compare it to other markets, that also help because you can see which one is lagging, which one is meant to go where, and that could help give you a better decision in terms of position trading. Now, the pros for position trading is that is way less time intensive. You may have to pay attention maybe once every 2 weeks to a month. That's if that even. You have increased flexibility because you do not need to watch the charts all the time. There's lower transactional costs because you're only paying once for entering. You're not paying. I guess you're paying commission, but you're not paying spread or stuff like that. So you're reducing transactional costs. It's way less stressful compared to day trading because you only need to make a few good decisions and you're sorted. And you can easily compound this over time. So if you had let's say you had a position here, you can just let it ride and you just add in more positions, take out here, do whatever you need to, and just hold it really. Now the cons of this, obviously, you will have to hold overnight, which is a given. The same issue occurs. You will need to have way larger patience compared to swing trading or day trading, and that is something that's either built up on or is when you 100% or have a higher tendency to believe your strategy. Obviously, larger capital is needed, the same reason as swing trading, and the same thing for opportunity costs as swing trading. Now, this is the most important part, which is dependent on accurate analysis. Because you're going to be holding for a long period of time, that means you need to make sure that whatever you're doing has the highest confluence of it moving in that direction or in that intended move, right? So you will need to spend majority of your time on this. Now, the instruments would be stocks, bonds, ETFs, cryptocurrencies, indices, commodities. The reason why I say all of these is because you can easily use the news or any information that you have to determine a long-term direction, right? Now, high frequency trading, algorithmic trading is more new. It's more modern compared to the other ones because it's more automated, and you use computers to execute and it's dependent on predefined criterias. Now, the criteria that you get will be from basically data collection or data that you've had before and analyzing that data. So majority of this is predominantly going to be used when you have a good solid understanding of backtesting and statistical arbitrage. Now what that means is when you backtest and you have your data, you can not easily, but you find specific patterns that may occur or specific things that occur from the data that you collect. Now, from that, you can find out when prices needs to do a specific thing or more likely to do a specific thing. So let's say, for example, it was 50-50 for buying and selling, and your backtesting and your statistical arbitrage finds out that when it gets to this day or this week or this month, it's most likely going to be a sell. Then you know you can sell, right? Now the pros is obviously speed because it just does it automatically. Consistency because there's no human emotion involved at all. It could be operated on 24/7 as it's just a robot. And you can also automate complex strategies, which is quite useful for people that get affected by psychological management. Now, the cons are there could be technical faults and you may not be aware of them until later on. This includes any biases that you may or may not have and you need to think about. That may not even occur or be thought about until later on. You also have very, very high costs because you've got to obviously implement technology and you've also got to get the actual data before you even make any money in the first place. So it has a way higher startup costs. Now, it can also be over optimized. Now, what I mean by over optimized is it can be optimized to the current market conditions. And when the market conditions change, because it is over optimized, it will not work in other market conditions. So you may have to simplify it so it works in all market conditions or have an on off button for specific market conditions. Now, pretty much the same instruments will work. Yeah. Now, social trading. This is the one that is my least favorite, purely because you don't really learn You don't really get to do anything. It's quite boring. What you do is you literally copy the trades of more experienced traders. Now, obviously, increases speed because you don't need to gain any knowledge. It's also more consistent because you're following someone else rather than you doing something. You gain expertise of other traders, which is beneficial, especially if you're new to trading, and it does save time because you don't need to go through the hassle of understanding the markets and knowing what you're doing. Now, the cons obviously is reliance. That does cause an issue in case, let's say, they go away or there's some issues that occur and they just stop. Overconfidence. If you get a track record of proven confidence for a short period of time, you may try to increase the risk in a specific trade, even though the trader that you're copying is against that. Now, there's also performance variables. Just because it's worked this week does not mean it will work next week. That is something you have to think about. Now, again, this is the thing I would not recommend at all. Unless you're really, really starting out, I would say start off with swing trading. It is the best way to start. And then you could focus on any other thing depending on how you want. And this is my presentation. Thank you, and hope you enjoyed this small presentation on the types of traders. Let me know if you have any questions or anything that you want me to sort of give a presentation on or work on, and I'll look to basically get it done. Thank you for your time.